Hi, and welcome to Hedge Fund Investor. I'm Karl-Mikael Siding. Today I'm going to talk a bit about macro. To start with, I just want to stress that you really shouldn't do this at home. Macroeconomics is for the absolute pros, and I do not count myself to one of them. I usually do look at the macro situation in order to help a little bit with my timing and make sure I avoid the really stupid mistakes. But if there's one thing that I just want to hammer home is that in 95% of the time you shouldn't care at all about the macro situation. Things like unemployment, inflation, interest rates, or trying to project these variables. Because there is a lot of huge investors, a lot of billions and trillions that are doing this on a systematic basis, and you should not want to get into competition with them or try to best them. There is really no way for you to predict macro variables in a way that's really helpful for your investments. If anything, you're typically a macro tourist, not a macro king. So you're just stumbling about in this macro landscape, trying to discern news and macro signals in order to make better investments. So what it's all about, what is macro? Well, it's the total context, it's the big picture, it's everything that happens outside the company you are analyzing or the stock that you want to invest in. So it's things outside the company that may or may not affect the trajectory of the important variables. So let's get back to basics. What is it you want to do when you analyze a company? Well, you're trying to project sales and earnings and valuation multiples on sales and earnings in order to make a forecast for the stock price and thus for the annual compound average returns that you get every year. And what you can do, if you're really good at this, then you can use information about what's happening for the entire economy, the national one or the global one. So what you can do then is look at growth rates, profitability rates, and other macro variables, including the valuation level for the entire stock market. And you can use those macro variables, which are more or less the same variables as for your single company. Use those to see if you have some kind of a headwind in terms of growth and profitability, or a tailwind that helps your company to actually fulfill their own objectives. So let's take a look at what we're really talking about here. So for one, we're talking about growth rates. That means looking at stuff like sentiment data, purchasing managers index data. So these are data series collected on a systematic basis since 50 or 100 years or even longer back. And looking at this data, we try to see what are the main decision makers doing in the economy, the purchasing managers, the CEOs, the politicians, the central bankers. What are they up to and how are they likely to change or make decisions in the coming months or years? And we want to use that in order to make better forecasts for the growth rates for our company. So let's say our company used to grow by 10% and it's saying that it still has the objective or it's guiding towards 10% growth. But if we at the same time see the market or the economy being absolutely red hot in terms of employment and inflation and growth rates, then maybe that helps with growth, at least right now and for the coming months or maybe the entire year. But it can also mean that the red hot economy is soon going to cool down, and that will actually make it more difficult to reach the target that the company is talking about. And we also have, for example, price trends in terms of how much money exists. Is the central bank, is it printing money? How do the interest rate curves look I mean, do we have high interest rates, low interest rates? Is the shape of long-term and short-term interest rates, is the shape that they form together, does it have a weird shape or a normal shape? And what does that mean for future interest rates and thus future growth and future profitability? Again, it's always the same variables. How much money will the company make and how much will that money be valued by the stock market? And that brings us to the valuation level. There are a couple of very commonly used valuation multiples. It's market cap over GDP. It's the Hussman MAPE. It's a kind of a price earnings ratio. It's the Q ratio that Buffett typically uses, and it's enterprise value to sales. And then we have a lot of other indicators. I mean, this page doesn't even begin to show you the hundreds, actually thousands of variables used by macro investors. So we have soft commodities prices. That's things like sugar and coffee and grains. I mean, they do hold information about what's happening in the economy, but probably not information that you should use. This, for example, this is the price to sales ratio. You can see we are very high up in the 35-year perspective. But is this extreme? Is it sustainable? And does it hold any information for us in order to make better predictions? There's another form of valuation multiples. This one goes back 100 years. We can see that we are at a peak comparable to the peak 100 years ago. This is probably an extreme enough level to take into account in our view of what if we have a headwind or a tailwind. So this would be a headwind. This chart shows the occurrence of warnings, technical analysis warnings, and they are becoming more and more frequent. Is that enough for us to take into account? Here's another one, and it's becoming very red up here in the last few years. But still, we haven't crashed. Take a look here. We are at record levels for the stock market, despite all these warnings. So perhaps we shouldn't take them into account after all. And here is true real data from something called FRED. It's the St. Louis Federal Reserve Bank. It shows data over whether the US economy is working at full capacity or below capacity. And that could tell us something about what will happen to growth going forward. And you can correlate these data with each other. So again, what are we trying to do here? We're using top-down data on growth and profitability and valuations in order to make better forecasts for our micro data, the company data, for growth, profitability, and valuation multiples. But keep in mind, these are just slight headwinds or tailwinds to our true analysis of the company. It's the company that matters. It's what the company is growing, how much profits it's making, and the likely valuation of that company that matters. This macro data, it's just a slight add-on for better timing and avoiding stupid mistakes. So, is this extreme? Is it sustainable? Is this a growth tailwind or not? It's usually very difficult to know. So my main recommendation here is to stay away from macro unless you know what you're doing, or you will get trampled by elephants. Okay, a little bit more. And this is for the real macro nerds. FRED, this is where you get the real data. This is what you see when you get into this Federal Reserve Bank statistics of economics. They have thousands, tens of thousands of series. You can search for gross domestic product, for example, and you will get tens of thousands of hits. After that search, you will get suggestions based on your search regarding, for example, GDP. And then you can click through and you'll get different formats. You'll get formats in terms of growth rates or the nominal data. And And here's an example of what happens when you click GDP and there. Yeah, we're up. But that doesn't matter because I did stop here and there. So yeah, you know, it does work. All right. I think it's better this way.
We're on the same subject.
Sorry?
We're on the same subject. We're going to continue, or
no, we're done with that one.
With that.
I mean, the last picture was really unnecessary. So it should be easy to just get it.
I'm just asking. So